Hey guys, it's Max. I want to thank everyone for returning to the station. I got Jackson right here by my side. All right, today I wanted to talk about a new covered call fund. I was going through the SEC dumpster and I found a yield max filing. In any event, it's for Ethereum. It's based on Ether. The thing that caught my attention wasn't the Ethereum or the Ether. Wasn't the fact that it's yield max, although that's I guess that is why I was looking. But I was looking because it was yield max. But then when I read the prospectus, I saw something that I really liked. 3 words that I really like. All right. I don't think we know what the underline is going to be. It didn't reference the underline, and I'm not up enough on these things to know. I mean, I know the Bitcoin ETF is BITO, and I know that some of those big ones, but I don't know if there is an Ethereum one, let alone one that trades options. If there is, I haven't heard of it. Anyway, let me know in the comments. I don't really think the underline going to matter that much. But this opportunistic call spread was a great move by Petrocelli. Let's check out option strat, and I'm just going to give a less than 5 minute, a 3 minute talk on calls on the opportunistic call spreads. Okay, I'm going to demonstrate with the SPY just to make it simpler. So here's the SPY. This is right now, it's trading at 563, or these are delayed 15 minutes. But anyway, so this is a trader's long 100 shares of the SPY. So a standard covered call would be, and let's do this for tomorrow because today doesn't have enough juice left in it. So let's do it for tomorrow's expiration. So a standard covered call would be you sell the 30 delta. That's the way a lot of these funds do it. There's the 20 delta. There's the 30 delta. Okay. Yeah, you sell the 30 delta. That's exactly right. There's some that do different ones, but this is a very typical arrangement. Okay. What this does is this gives you a profit and loss graph at expiration that looks like this. So if the market goes up, the dotted line is where the market is now. So if the market goes up 1%, this strategy's capped. It only makes $256. The good thing is if the market goes up a little bit, like 0.3%, this strategy makes the same amount of money that it would have made if somebody had stock, and it also makes the credit from the premium. This brings in $68, which isn't a lot of money. But anyway, okay, so all a call spread is you add a call behind it. They usually have a formula for how wide the strikes are, but this is different on the SPY and the S&P. So just this is fine. Okay. So if a person did a trade like this, they would still have SPY and they would still write the same call and they would still receive the same 67 cents. They would spend 11 of that or 12 of that 67 cents on this position. Okay. And then the thing is, if between now and tomorrow the market is up 1%, and the other example, they made $256 if the market's up 1%. In this example, they make $323. So we can look. The market's up, 2%. They make $256. If the market's up 2%, and it goes up 2% some days, you make $880 when the fund does a strategy like this. This uncapping the upside is huge. This prevents the NAV from appearing like it's decaying so bad. This is a big component in helping combat that. All right, so I hope that was quick and not too bad. So now let's go back to, that's what an opportunistic call spread is. We're going to read the wording in the prospectus, but that's basically, so Jay, and this is the first time I've seen this in any of Jay's prospectuses, and that's what I'm excited about. I don't care about the Ether, the Ethereum exposure. It's cool for the sake of diversification, I wish they had these high yield funds on every asset, and that's what they're trying to do, I guess. I wish they had them on real estate. I wish that they had them on senior loan portfolios. You could do this on lots of underlines anyway. So it's badass they're doing this on Ether, Ethereum. I don't really have any thoughts on the future of Ether or Ethereum, but I have thoughts on covered calls, and I really like this, and I really like the modern covered call. I think is no longer covered. The modern covered call Jay invented is the call spread. I think you're going to see more and more of this because it's a great happy medium. And for a long time, the covered calls had problems, and Mr. Petrocelli's fixed them, in my opinion. All right, so now we're going to look at the prospectus. So we're going to go back to here, and then we're going to go to here, and to here maybe. Okay, so I found this when I was dumpster diving last night. So it's dated July 11th. So this is Yield Max Ether Option Income Strategy ETF Fund Summary. Okay, objective, current income. That's all it says, But, well, it does say secondary objectives seek exposure to the share price of a select exchange-traded product subject to a limit on potential investment gains. Okay, but they don't say what that ETF is. I'm sure somebody out there knows, but I don't know yet. Like I say, I don't think it matters that much. Just as long as it could be on any asset that's liquid and that has a liquid options pit. The options are liquid. It needs liquid options. Okay, so principal investment strategy. The fund is actively managed. The fund is it seeks current income while providing indirect exposure to the share price of one or more select U.S. listed ETFs that seek exposure to Ether, which is a cryptocurrency. Each underlying ETF is subject to a limit on potential investment gains as a result of the nature of the option strategy it employs, like we just looked at in the last one, covered calls for cap. That's just the way it is. All right. Although Ether may be referred to as cryptocurrency, it's not widely accepted as a means of payment. Fund uses a synthetic option strategy designed to provide income and indirect exposure. Okay. In addition to the use of options to gain indirect exposure to the share price returns of this unnamed ETF, the fund uses a standard covered call strategy, but from time to time may engage in an opportunistic credit call spread strategy instead. In each case to generate income, though. It's still an income trade. So let's see what else they have to say about it. The fund's standard covered call option strategy will cap its potential gains. When the fund uses the opportunistic credit call spread option strategy, the fund may benefit from larger gains experienced by a particular underlying ETF, but in those cases will forego some of the initial gains in the underlying ETF. And I just showed you in that example how that works. That one option was you could sell for 67 cents, but we had to buy the option for 12 cents behind it. So instead of bringing in 67 cents, we brought in 55 cents. So it's, about a 20% hit to your initial, premium or to the income generation. So, it's something to consider. I wanted to show you guys something else. Let's read this. They go in a little bit more, and this has Jay's fingerprints all over it, but it says from time to time, the fund may sell at credit call spread rather than a standalone option contract to seek greater participation in the potential appreciation of the underlying ETF while still generating net premium income. The sub-advisor will primarily employ this opportunistic strategy when it believes the share price of a particular underlying ETF is likely to rise significantly in the short term, i.e. following a substantial sell-off, in other words, when it's due for a big bounce, or overall positive market news. Additionally, the sub-advisor may use this strategy in other scenarios where it believes the use of a credit call spread may provide more advantageous results to the fund's total return than the standard strategy. Maybe around earnings or something, or yeah, given certain circumstances, I guess they could choose to use the call spread and sometimes to be fully capped. Fully capped, it generally works out better on the downside because the buffers, what the income is the buffer. So if the market's going to drop, you're better off not using the call spread. The call spread only helps you when the market goes up. It not only goes up, it has to go up further than the highest strike in the call spread. But I think it's a good strategy, and I don't know why they don't put a fund together and just use it all the time. I don't like the guessing and going back and forth. But I get where they're at here. So like maybe right around earnings, they'll put on the call spread because they won't want to, cap it. And maybe like after a big sell off and when it's going to bounce, kind of like what happened to Tesla a few months ago, they'll uncap it or something. Anyway, I think it's a great idea. Like I say, my only criticism is they ought to do it all the time, but they do it all the time. There are target funds that are full-time target funds, and we have SPY-T, triple QT, and I guess we're going to get IWMT soon also. All right, so let's see if there's anything else in here. Monthly distributions. I think this is just preliminary. They talk about what Ether is, and they don't even know what the ETF is. Anyway, but I thought this was interesting. Let's make sure there's nothing else. Short call. Well, I think it's pretty standard other than the opportunistic call spread. It's Investment Advisors Title, which is Mike Venuto's company. I need to get him on this channel. I need to get him in for an interview. That would be awesome. That would be a huge get. He's a monster in the ETF industry. And of course, Zega's the sub-advisor. Portfolio managers are Jay and Christopher Mullen. I met Mr. Mullen, a really nice guy. He was in New York. Poor guy. Jay had him talk with Retire on Dividends, and me and Corey. But anyway, he was really nice and a good sport, and he answered all our questions about putting the strikes too close to the money and stuff. Anyway, so that's awesome. So now he's in charge of this one also. And there's another name that I don't know how to pronounce, and I have not seen that name yet. So maybe it's someone new. But in any event, that's awesome. All right. Well, let's get back here. Okay, I really don't know if the underlying matters. Like I said, they just need to put these on as many things as possible. And of course it matters. To some extent, it's the only thing that matters. But it just has to have, the main thing that they need is a liquid options pit, because they're just using the underlines. They aren't necessarily bullish in these underlines, I don't think. But they're just using the underlines as a means to generate income. So, but if you listen to Sylvia yesterday, she was kind of more surprised that people weren't more into USOY with all the stuff that's going on in the world, because as things in the world happen, and then theoretically the demand for oil should pick up, especially if we have wars in the Middle East and stuff, and the economy's going well too. And so, oil's through the roof. Well, if you have USOY, even though you don't participate fully, you can see in funds where something's through the roof, like Misty and Coney and something, even though you don't participate fully in VIDI, you still get tons of upside. So, I mean, that's something to think about. So in any event, if you're a bull on, of course, if you're a bull on crypto and Ethereum, yes, this is awesome. Of course, there's always the risk if we've already topped out for this cycle in crypto, but I don't know. And there's also the problem that crypto could keep going up and the vol could get super compressed, but that's a good problem to have. And the other side is just like any covered call fund, and everyone says, "Oh, how are they going to do when the market goes down?" Well, we know one thing we know is they do better typically than the underlying does, and that's just by virtue of the sold option. So I also wanted to say, keep an eye out for Panda Suerte. I should have put his YouTube station in there, but I'll share the link better. He'll put a review out on this, and he'll go into the nitty gritty. And so will Rod. Retire on Dividends will read every line of this, and and you'll have a thorough understanding of it. That's not what this was intended for. I was just trying to talk about call spreads and why they're a better strategy, in my opinion. And because you're going to be hearing a lot more about them, because for months I've been bothering Jay and asking him to please, put out more funds with call spreads. Anyway, this is the first fund. Well, SPY-T and QT were the first funds, but then after that, this is the first fund since then that has had the opportunistic call spread. But I believe I heard him hint in the interview with Retire on Dividends that they were all going to be that way. Or I think he says they're making some changes to the prospectuses to give them some more freedom to do some more interesting stuff. What do you want to bet they're doing this in all the funds? I bet they just change it. I bet they change it on triple QI. Maybe I'm wrong. Actually, I bet they don't change it. I bet they leave those how they are, because Sylvia's mentioned before that a lot of people are really happy with those. A lot of professionals, she's kind of insinuated, are happy with those, and they don't want her to touch a thing. So, so I don't know. We'll see, but we'll see. But I'll definitely say this on ULTY. I think they will put in the prospectus opportunistic call spreads. And I hope they do it on YMAX and YMAG also. So we'll see. But yeah, on triple QI and IWMY and I've heard Jay say it before too. People are, those things make more return than, like, the only way you can get that much money is in wildcatting oil wells. I mean, some of these things that are, that where you double your money in a year, that's unheard of, especially in a fixed income environment. It's crazy. Like I always say, it's one of the greatest opportunities I've seen in all the years I've been doing this. Anyway, and it's just beginning, and it's and there's something for everybody, and that's the part I like, and that's what my videos kind of focus on. That's why I like to focus in on the strategies, because if you understand the strategies, there's some people that are hyper-focused on the NAV erosion element of it. Well, if you understand the strategies, you can avoid that altogether, and not by doing something, not by buying more, just by buying more will help also. You can dollar cost average, and that helps, but just by choosing the right fund, you can choose funds that don't have or don't appear like they have. They all have, it's just part of the deal with the dividend fund. They all have it, but you could choose funds that don't appear like they have. So, and anyway, that's kind of what I like to specialize in. So I'm going to make more videos on the individual qualities of each fund. All right, guys. Well, I hope you like this one, and I will talk to you later.